Next week, we're expected to get details on the tax plan. We're expected to see some progress in terms of health care. Do you believe new policies now, and these are based on principles, new policies will move the needle on economic growth? And does that create a better backdrop for investing?
I think if you're looking at the magnitudes of those changes, they're unlikely to be game changers. Okay? I think the real question is more, what is the environment as a business-friendly, hospitable-friendly environment to increase productivity? And I really do believe that there's a lot of potential to have the sort of changes in coding.
Because if it's a much better business environment.
Because we have a pro-business environment. Do we have an environment in which it's okay to make new things and be innovative, but it has to include the population as a whole. That's why, as I say, you're sort of in a situation where you'll either be able to write code or you're going to be unemployed, those who write code to make algorithms. And so the potential of thinking about how do you educate people to speak that new language and then to have them employed working next to people like myself who doesn't know how to write code,
right,
or yourself,
right,
and think about how you can convert your thinking into algorithms so that this could be pervasive around the country. This could be a great potential. There are things, many things that could be done. So I would be excited about those things, but I think that the actual changes. I'll give you an example. What the Fed's tightening for the balance sheet is about 2.5% of GDP. Okay, that's taking a lot of money essentially out of the economy. Okay. That if we have an increase in the deficit, which is fiscally stimulative, it also means that that increase, I would think, might add about another 2.5% that has to be sold in bonds. So part of what you're having in stimulus and fiscal is being taken away by monetary. So now imagine that 5% of GDP, something like that, could be taken away in the form of selling more bonds. Yeah. That has an implication of itself. So monetary policy is going to be an important consideration, I think, at this time.
I think you make a really good point, because we are right now at a moment in time where the economic story is gaining traction. We saw a pretty good GDP the other day. We're looking at businesses trying to create more jobs. Is the Federal Reserve going to stop that recovery just when it starts to get traction?
I think that the Federal Reserve has got to be extremely cautious. The risks are asymmetric. In other words, the risk of a downturn is much worse than the risk of not being able to fight inflation. And that's for a lot of reasons. First of all, there's a limitation as to how much interest rates can be cut. There's a limitation of the marginal effectiveness of new quantitative easing, okay? And if you have a downturn now, you're going to have a social economic split. We have asset prices that are much more sensitive. The durations of those assets have lengthened. And if I take the price is all built into the curve, the interest rate curve. So if you take the curve, the short-term rates, the bond yields, and so on, and you take expected returns of equities and you drive that curve, that curve is very sensitive throughout the curve, all assets, on what that yield is. If you raise interest rates faster than is discounted in that curve, all asset prices suffer as a result of that. So we have asymmetric risks. We don't have much of a risk of inflation. The Federal Reserve has demonstrated for the last year and a half that everything that it has said about the rate of tightening, it didn't pursue. If you look at how they said they would raise rates, they didn't raise those rates because the economy as a whole didn't operate in a way that warranted that.
Right.
When you look at inflation and you hear their conversations on inflation, they can't explain why the inflation rate hasn't risen that they have theoretically said should rise.
Well, there is a conundrum in this country right now. We're seeing job growth, we're seeing economic growth, a little more than maybe the last 8 years, but wages aren't moving.
Well, I think it's largely because you could see it when you look at the nitty-gritty level. And what we're defining it as a relationship between labor and inflation, whereas the workforce, it's a new workforce.
That's right.
If you're thinking about this, part of the workforce are essentially the robotics or the technologies that are now competing with other people.
That's right.
And so it's changing the nature of those jobs. So if you're the Federal Reserve and you're not sure you understand that, and you don't yet have inflation much expectations, and besides, don't get too precise about that inflation number, and you have the other downside, I think that you have to wait to start to see the whites of inflation, or at least understand why it is that you're going to be doing that. Yeah, so I'm concerned about the Fed's rate of tightening. I don't think that they will actually be able to tighten at that rate that they're telling you.